Good morning from our global headquarters in New York. I'm Manish Krenny. You're welcome to Bloomberg Brief. Let's set that agenda. Big tech's big break. The Nasdaq 100 hits a record 20,000 as the data cements the Fed's rate cut bet. But first, we're counting down to the ECB, expected to make its fourth cut of the year as inflation nears 2%. And save the date. President-elect Donald Trump invites China's Xi Jinping to attend his inauguration ceremony. That has infused a little bit of risk on in some of the Asia trades, but to ground zero here in the United States of America. Post-CPI, we're 95% lock. Probability of a rate cut next week in December. So we are just seeing a little bit of heft in the U.S. equity markets. You can see we're just coming off those highs yesterday. What a magnificent number for the Nasdaq, the composite 20,000. We're 21,750 on the 100, and the Russell just giving back an eighth of 1% this morning. You've got to ask yourself the question, though. The dividend yield is a little bit lower than BBB, and that is a warning shot. The bond market, we've got PPI today. Of course, this is all about building towards the final PCE, and that's expected to come in at plus 0.3% on the PPI. They turned up yesterday. Demand for the 10-year auction was the strongest since 2016. Loretta Mester has a warning for the market, though. You need to rethink 2025. Inflation progress has stalled out a bit. We'll talk about those rates and those markets in just a moment. We're also keeping an eye on a couple of stocks for you. Adobe falling after a disappointing annual sales outlook. Uber stock, it's on the up this morning. Management making some upbeat comments at an industry conference, up nearly 4%. And Broadcom, it's dipping slightly before it reports today. Those earnings will be after the bell, down by 0.4%. And in just a few moments, we'll start the conversation about markets with Elsa Lignos of RBC. And later this hour, Bob Elliott of Unlimited joins me. Let's test his exuberance. First up, it is the ECB. They're set to announce the last rate decision of 2024 this morning. Let's get to Frankfurt. Lizzie Burden is with me. Lizzie, there was a great deal of debate a couple of weeks ago. It was going to be 50 basis points. Consensus is around 25. How dovish will Lagarde be? Maybe that's the more prescient issue.
It definitely is, Manus, because think of everything that's happened since the last meeting. You've got the collapsed governments in France and Germany, maybe less fiscal tightening for the ECB to rely on to help fight inflation. Donald Trump re-elected and the euro area very much in the firing line when it comes to his tariffs. So, yes, there are some who say that 50 basis points will be on the table today, but it looks unlikely. Maybe, as you say, you'll hear a change in the language, specifically the part of the statement that last time said they'll keep policy rates sufficiently restrictive for as long as necessary. Maybe they tweak that language. Also, those risks might change the forecast today. They're looking out to 2027, lots of uncertainty to factor in, so they'll probably rely on scenarios rather than a base case. But further out, the debate really is about where rates settle. Do they go to 2%, as economists think? Will they go to 1.75%, as traders think? Really, it comes down to the extent monetary policy can actually help with Europe's economic woes, as so bluntly spelt out by Mario Draghi. Isabel Schnabel would make the argument that actually this is why you need to stop cutting rates sooner.
The debate is this, of course. Look at the language that's been used towards Mexico and Canada so far by President-elect Donald Trump. He hasn't started on Europe yet, has he?
More because of the inflationary impact of domestic US economic policy, slowing down Fed cuts, creating a divergence across the pond and actually feeling it more through the currency. There again is a split on the ECB Governing Council as to whether the growth risks from tariffs are more important than that inflation risk. But again, this is something that should come out in the press conference, but Lagarde not going to want to wade into politics.
No, she's definitely not. But it's probably an unavoidable one. It seems to be a feature of a lot of the central bank press conferences afterwards. Lizzie, we'll speak to you a little bit later on. Lizzie Burden at the ECB headquarters. My guest this morning is Elsa Lignos, Global Head of FX Strategy at RBC. Elsa, good to have you with us. We seem to have come off that real high pressure point for 50 basis points. Same question to you. How dovish does Lagarde probably be today?
I think she's likely to continue the tone we've heard in recent press conferences, which is cautious. Certainly a lot of people are expecting downward revisions to both those growth and inflation forecasts. But at the same time, as you mentioned in your intro, there's a fair degree of uncertainty around 2025, both how much we're going to see from Donald Trump, but also what we're going to see both pre and post-election in Germany in terms of fiscal support. And I think there's room for both of those to change things quite materially. And so I'd be surprised if Lagarde wants to commit herself to any particular path.
Do you think domestically, when you look at Europe, I mean, the inflation numbers ticked up ever so slightly. Growth was a little bit better than estimated. Do you think we've skirted the worst? Do you think we've passed peak chaos economically and politically in Europe?
Well, there's some interesting signs of stabilization. If you look at the Q3 data, signs of private consumption turning positive. We've been seeing that for a couple of quarters now in the UK. It's definitely encouraging sign to see that happening in Europe. And at the same time, you've also got the prospect for some fiscal support as you look ahead to 2025. Certainly, it's hard to see the French government undertaking any kind of fiscal consolidation, and the German government, as I said earlier, likely to be fiscally easier. But skirting the worst, I mean, a large part of that will depend on the external shocks as well. There's a wide range of views in the market as to how much Trump may implement and what the knock-on impact on Europe will be.
Are you any closer to the point of where you would say buy euro dollar?
I think it'd be premature, in large part because it's a negative carry trade. And, Manus, we've spoken so many times over the year. We started the year in a position where we had 108 for euro dollar, so we were never real euro bulls, and we remain in that category. But equally, I'm not in a rush to make calls for 95 or 80. There's certainly scenarios where you can see euro dollar testing parity or even trading below. But also, I think what we've seen in the past 2 weeks with all the negative news that's been thrown at the euro and the fact that we're still trading where we are today, the hurdle for seeing downside in euro dollar is actually pretty high.
And I think that's it. The market is so reluctant to be long of euro because there are a quantum of risk going into 2025. Look, if we pivot to the Fed, the CPI was sort of green-lit the probability of a 25 basis point cut from the Fed. But again, let's just invert the language there. How hawkish a cut do you think we'll probably get from the Fed?
I mean, it doesn't feel like they need to be particularly dovish at this stage, right? When you look at the prospects for 2025, and again, we were already in the camp pre-election that the Fed was going to have a higher terminal rate. Our forecast was for 4 to 4.25. We remain with that forecast post-election, and certainly there are a number of things that Trump could do that would be quite inflationary in the US. The backdrop, the growth backdrop, for some, it's concerning. When we look at it, actually, there's still some fairly positive signs of growth there. Putting it all together, you could actually make the case for the Fed skipping this meeting. I know nobody expects that. Certainly, the market's not priced for it at all, and the Fed don't like to surprise. But really, if you're starting with a blank sheet of paper, you kind of question, do we really need much easier policy at this stage?
But that's what Loretta Mester basically, cautioned the market yesterday, where she said, you need to start to rethink 2025. I mean, we may well get a Wall Street Journal article between now and when the event happens, but that sort of helps us. But Loretta Mester said, rethink 2025. Disinflation has stalled, and you possibly need to rethink the cuts. And therein lies the issue for the dollar, because it's a recalibrating of the dollar to a pause. I take it that the dollar would welcome a pause.
Absolutely. I mean, I think if you look at the dollar right now, the fact that it's that higher yielder in G10 relative terms, that means that you're comfortable just sitting in a long dollar position, in spot terms at least, because you're not paying carry. In many cases, you're earning carry. And so I think that supports those long dollar positions out there. The biggest risk for the dollar really looking ahead to 2025 is if we see an unexpected slowdown, economic slowdown in the US. And then, of course, you do see euro dollar a lot higher, dollar yen a lot lower. That's just not a base case forecast at the moment, and we have to see signs of it happening before trying to position for it.
The one thing that I was surprised on reading your notes is that you say almost everybody you speak to is long dollar. Fine, that's consensus, but not in huge size. And yet, you talk to the other parts of the market and they say, this dollar will exhaust itself by December because on a relative basis, it is so strong. What kind of underpositioning are you actually seeing?
Well, I think there are a number of people that took some profit on their long dollar positions and may also have been positioned in options rather than spot. And so either those structures rolled off or they hit their targets and restructured. So at the moment, it feels like people heading into the end of the year and nobody expecting massive dollar move into year end. A lot of people have actually lightened up on risk quite materially. And I'm not saying that means necessarily the dollar explodes high from here, but it just gives you some sense for the balance of risk. I mean, if we do see Trump threats, for example, on tariffs hitting between Christmas and New Year's Eve, you could potentially actually see a fairly sizable dollar move as people kind of rush to put those positions back on.
Yeah, well, a lot can happen between now, as you say, and New Year's Eve. And then look at the SMB and Canada. They went for jumbo, back-to-back jumbo cuts by Canada. And the SMB certainly took the market by surprise. Elsa, we've run out of time. The clock clicked down. Elsa Lignos there of RBC. We're counting down, of course, to the ECB decision later today. There are stories, other stories trending on your Bloomberg terminal. This is what we've got for you. As I say, the Swiss National Bank has cut its interest rate by 50 basis points. It was a surprise move. The decision is aimed at defending the franc and fighting low inflation, but also may use up precious ammunition, leaving the central bank limited options if borrowing costs reach zero. South Korea's opposition Democratic Party files another impeachment motion on President Yoon, with a vote expected on Saturday. In an address, he vowed he would fight until the last minute to defend himself over the declaration of martial law, but more ruling party members saying they'll support impeachment moves against him. Large US banks will have to cap their overdraft fees at $5, or an amount that covers their costs and losses, under a new consumer protection rule that's been vigorously opposed by the industry and by Republicans. The rule will aim to reduce the average $35 charge Americans face when they go overdrawn at their bank account, according to the CFPB. Coming up, will Xi Jinping attend Donald Trump's inauguration? The president-elect seems to hope so. More on this story right here on Bloomberg Brief. Context matters. Good morning. Hey, it's Bloomberg Brief. I'm Screnny in New York. Good morning to you. We're less than 6 weeks to go before the inauguration of President-elect Donald Trump, and he has extended an invitation to attend to his Chinese President Xi Jinping. That is according to a report from CBS News. Let's get to our senior editor, Bill Ferries. He's in Singapore. Bill, I've got to ask myself, is this a real political olive branch, a tactical play, or game theory writ large? What do you make of this invitation? Could it even happen?
Well, you know, for starters, it could be an olive branch after a campaign in which Donald Trump repeatedly said he'd throw a lot of tariffs on China from day one. But I am having a hard time imagining Xi Jinping, you know, sitting in a folding chair on a field in Washington on a cold January day, watching President Donald Trump take office and potentially go off script and announce tariffs, insult China, or anything else like that. Remember, President-elect Trump just this week online called Canadian Prime Minister Justin Trudeau the governor of the state of Canada. So the political risk for Xi Jinping would be very high. On top of all that, foreign leaders do not attend U.S. presidential inaugurations. We look back in State Department records all the way to at least 1874. It hasn't happened. No Chinese leader, of course, has done that either. So I think it's highly unlikely. But if you wanted to look at the glass half full, you know, possibility, sure, it's an olive branch to China. It's obviously going to be a rocky road in the weeks, months ahead of the Trump term.
I think it was a slightly more interesting nuance this morning. You've got the Ministry of Finance basically saying, we want to manage our differences. We're willing to increase our talks with the U.S. on trade. That's perhaps a little bit more significant, isn't it? Because that's about incremental moves to engage.
Sure. I mean, I think any sign that these two nations, the world's two biggest economies, are going to have some kind of a functioning relationship, and that it's not just going to be about a public relations war, announcements on Truth Social or on X, you know, that's going to be positive. If you remember the early start of the Biden administration, Anthony Blinken, Secretary of State, met with his Chinese counterparts in Alaska in March 2021. That didn't really go that well, but it at least got leaders off to some talks that were able to continue.
Look, let's just wrap up with the FBI. Christopher Wray is set to announce that he's going to resign. This, of course, clears the way for Kash Patel. This is pragmatism, really, isn't it, in terms of the leader? He was appointed by Trump, but it's not exactly what you call the most wonderful relationship.
Yeah, you got to remember, he came in after Trump fired the predecessor, James Comey, over the Russia investigation. So Christopher Wray was Trump's pick. He and his supporters started to sour on Wray for a variety of things, including FBI going into Mar-a-Lago after Trump left office, looking for classified documents. Wray also helped prosecute January 6th protesters that Donald Trump has said he may pardon on day one of his presidency. So it's been a bad relationship. I think this does take away that distraction. Donald Trump can appoint an interim FBI director while Kash Patel goes through the confirmation process. So it does give Trump a clean slate there. OK, well,
as Christopher Wray said, it's the best way to avoid dragging the Bureau deeper into the fray. Bill, thank you very much. Great conversation this morning with Bill Ferries. Coming up, another story that we're watching on Bloomberg. We've learned that President-elect Donald Trump is scheduled to ring the opening bell at the New York Stock Exchange later today. Will that match up to Madison Square Garden? Coming up, NVIDIA steps on the gas. More headcount in China for the automotive project. What's it all about? We'll tell you right here on Bloomberg Brief. It's Bloomberg Brief. I'm Menace Cranny in New York. Time for the front pages. This is what we've got for you. Headlines from around the world. First up, the Associated Press to France is expected to name a new prime minister today. At issue on the search are both policies and personalities. Those in circulation are reportedly names that have been around for years, but an outsider could always emerge from the pack. Next up, also on the Associated Press, the IEA saying oil markets face a glut in 2025, despite last week's decision by OPEC Plus to delay the supply increases. It forecasts an oversupply of 1.4 million barrels a day if the current plan to proceed goes ahead. Global consumption is expected to grow by 1.1 million barrels through 2025. And Bloomberg leads with NVIDIA adding more staff in China to focus on AI-driven cars. It added 200 people to beef up the team. The world's second most valuable company will end the year with about 4,000 people, up from 3,000 at the start of the year. Let's get to our executive editor for Global Tech, Peter Elstrom. Peter, tell me this. What is this push into AI autos by NVIDIA? We know they've got restrictions around some of the chips they can sell into China. So what does this do? What's this push about?
Yeah, it's a good question. Manus, of course, it's not a surprise that NVIDIA is expanding. Its business is booming right now, especially because of this very strong demand for its AI chips in particular. So it is adding staff in many, many different markets. But as you alluded to, China is one of those markets where it can't sell its most advanced AI chips. So why is it doing this expansion? Well, the key here in the China market is they're working on technologies for autonomous driving. China, of course, is the biggest auto market in the world. They've also been a leader in EV cars. They're trying to push into autonomous driving, and NVIDIA is trying to beef up their engineering capabilities there so that they can serve that market. And not coincidentally, they also want to have these strong relationships with Chinese companies if there is some warming between the U.S. and China, and they're able to get back in there with the AI chips where they make most of their money at this point.
I just wonder what Elon Musk will be saying to President-elect Donald Trump about the prospect of Jensen Huang getting involved in autonomous driving in China. But look, this is a company which is in growth mode. Workforce has grown by, 25% this year, and they'll probably expand by the same level next year. Where will they go for growth in the headcount?
Well, NVIDIA more broadly is really riding this tremendous boom in AI. So they're a little bit concentrated with their major customers right now. They're selling those AI chips into the hyperscalers, especially Google, Microsoft, Amazon in particular. So that's really their big area right now. But they want to expand beyond those core four into other markets where Some of these upstarts want to develop AI models. They want to get access to NVIDIA's most valuable AI chips. So Jensen Huang has been accelerating their pace of innovation. They're trying to come out with new generations of chips really every year now to add to that market and to serve this insatiable demand for the AI services that people are appearing to have at this point. Their customers still need to show that these services can turn profitable. It's a big question overhanging, I think, the AI market right now. Some of them have made progress, like Microsoft in particular, and some have a long ways to go. So we'll see how this plays out. But right now, NVIDIA and Jensen Huang are really focused on that golden opportunity.
Okay, Peter, great to have you with me this morning. That is Peter Elstrom on the very latest for NVIDIA. Quick snapshot of the markets. Bob Elliott is standing by. We'll find out just how exuberant he is. At the moment, you're stepping back by 1/8% on stocks, and you've got the dollar slightly on the back foot this morning. We'll take you through the headlines and what Bob Elliott believes you should be doing with your portfolio from Unlimited. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Menace Crenny. Let's set your agenda. Big techs, big break. The Nasdaq hits a record 20,000 as the data cements the Fed's rate cut bets. But first, we're counting down to the ECB, expected to make its fourth cut of the year as inflation nears 2%. And save the date, President-elect Donald Trump invites China's Xi Jinping to attend his inauguration ceremony. Will he accept? It would be rather unprecedented. Let's have a snapshot of markets. Right now, there's a little bit of optimism, which has faded in the overnight. I can tell you the actual Nasdaq comp went through 20,000 splendidly yesterday. Obviously, Nasdaq futures trading at 21,743. So we're giving back 1/4%. And there is the cash, as you can see, last night at 1.77%. Where's the valuation here? You know, the Nasdaq's trading at a PE of 29. The S&P is at 22. Of course, they're two very different things. But the Nasdaq's still at a 5-year average. Roll it over. Have a look at the bond market. We're counting down to PPI today and then obviously to PCE and the Fed's decision. It's expected. If you listen to Loretta Mester, you've got to rethink 2025. Inflation progress has stalled out a little bit. So yields rise ever so slightly. We're counting down to the PPI. As I say, my guest is Bob Elliott, CEO, CIO of Unlimited. Bob, good morning to you.
Good morning.
I mean, we're breathless with record highs, more than 50 record highs this year on the S&P 500. There is this sense of euphoria, animal spirits. Calibrate your exuberance right now.
Well, a lot of folks are worried because, you know, prices keep hitting highs. As you noted, valuations are relatively elevated from any perspective. The issue is the valuations really only matter when you start to get enough central bank tightening to roll over the cycle. And we're getting exactly the opposite. In fact, what we're getting right now is a perfect combination of pretty good growth conditions and central bank easing. In the U.S. in particular, where growth is 2 to 3%. And the Fed keeps cutting. But really globally, we're seeing the same type of conditions play out, where global growth is pretty stable at 3%. Inflation continues to be a little bit elevated. And yet central banks have already delivered 100 basis points of cuts and are plan to cut another 100 basis points in 25.
And here's what you say. The Fed will keep cutting and Powell will cherry pick. I love this. He will cherry pick some other data to prove that monetary policy is very restrictive. I mean, is it restricted? Given market exuberance, one would say policy is not restricted. Given the math, you would say it is restrictive.
Well, there's something like 500 academics sitting at the Fed running models and saying that Fed policy is very restrictive, not looking at the fact that asset prices are hitting all-time highs, that spreads are at all-time lows, that the economy is running at 2 to 3%. The unemployment rate is pretty low by any reasonable measure. And the reality is Fed policy restrictive or not? It's not a theoretical question. It's not a model question. It's an empirical question. And the empirics are very clear. Growth is pretty good. Inflation is still elevated. And yet the Fed Chairman Powell will go up there on the stage, next week, and he'll say, hey, look, very restrictive policy. We need to bring rates down.
You should go and have a bit of lunch with Mark Rowan then over at Apollo, because he sat down with Johnny and he said it was one of the most expensive jumbo rate cuts that we've had. You're right. We saw the SMB do a shock 50 basis points. Canada, back-to-back 50 basis point cuts. So you are looking at this, whether it's not synchronized rate cutting 2024, but do you get the same level of cutting in 2025?
Well, right now, what's priced into markets is essentially the same magnitude of cuts that we've seen in 2024 playing out again in 2025. And that's a pretty aggressive set of cuts, 200 basis points total of cuts. The last time we had cuts of this magnitude, the financial crisis and the 2000 bust. And certainly conditions look nothing like the financial crisis and the 2000 bust.
But then we started this year with a very, very high bar in terms of what we thought was going to be delivered in cuts. We're not ending the year anywhere near that. But continue the thought. So over the 2 years, 200 basis points, and you haven't had that since GFC. Right. You don't think we'll get that?
Well, I think we probably will get that because I think central banks are looking at what they believe to be a neutral rate. Look at the ECB. They're saying the neutral rate is 2% or 1.75%. Well, if that's what you believe the neutral rate is, then you've got a long way to go. And the problem is that the impact of the cuts on the real economy, it doesn't occur instantaneously. It occurs in the financial markets. That's what we're seeing in the financial markets, pushing to new highs. But the effects in the real economy are going to take some time to flow through. Those 200 basis points of cuts, we're going to really start to see the effects in 25 and 26. Getting all that monetary easing and that stimulation into economies where inflation is still above the mandate across basically all of these economies.
This goes back to what kind of inflation you end up getting. And I like what David Kelly had to say yesterday. We've got rich world inflation and we have poor world deflation. I just wonder from a portfolio concept, you talk about airlines, hotels, cars, that's the rich inflation. The deflation will be obviously in shelter, perhaps in some of the energy areas. So how do you take that bifurcation in inflation and overlay it onto portfolio?
Well, I think the main thing you want to focus on is the source of inflation, which is really nominal spending, particularly by households. What's driving that is their nominal wages. And so if you start at wage growth, whether you're looking at the U.S. or Europe, for instance, you continue to see wage growth that's running at 5%. That 5% is translating into spending, nominal spending of about 5%, into economies that have, in the European context, very weak productivity, very hard to get, to basically produce. If you're spending on a 5% nominal basis and you have zero productivity, there is embedded inflation pressures in the economy. And that's exactly what we see. I wouldn't necessarily call it rich world inflation. And
well, that was Mr. Kelly's quote. Not me.
Mr. Kelly's quote. I call it more the services versus production divide, where services inflation is driven by wage inflation, and that's remaining elevated. Goods inflation has come down, but a big part of that is the backside of the bullwhip, where you had the COVID-related challenges, production challenges. Now you've gotten supply to come back online. Now we're seeing a normalizing. We're starting to see a normalizing even in the goods side of things. So if you have elevated services inflation and normalizing goods inflation, that's adding up to seeing a rise in inflationary pressures, which is basically exactly what we're seeing whether you're looking at the U.S. or the European context.
So given that backdrop, it's interesting you would say that bank lending is back at GFC levels, or sorry, recession-like levels. So if we extrapolate what you just said, which is further rate cuts to come, another 100 basis points next year, does that then give me a kicker from renewed bank lending? Does that come from the small business community, which has been the most sort of, I suppose, repressed through this flying high, equity markets? Equity markets look as if they're on fire, but you've had a real recession in small businesses.
Right. I mean, so far we've had what I call the income-driven expansion, where households are earning wages and spending it, but they're not borrowing. Nothing like what we saw in the pre-GFC period or in the 90s when businesses were borrowing a lot to do investment related to the tech sector. And so the reason why that is because rates were elevated enough that it didn't make necessarily sense for them to borrow. But as rates come down, what we're likely to see, particularly, is a shortening of the duration of borrowing, more floating borrowing, the rise again of the floater mortgage. It's coming back. And as a result, households and businesses are going to be able to use that credit in order to fuel further investment and keep this expansion going.
Okay, well, long live the expansion, long live the records. Bob, good to see you this morning. That's my guest this morning, Bob Elliott of Unlimited. Coming up, President-elect Trump reportedly invited China's Xi Jinping to his inauguration. Will he come? We'll give you the lowdown on that invitation in just a moment, right here on Bloomberg. is Bloomberg Brief. I'm Menace Cranny in New York. 3 hours away from the ECB's rate decision. We're expecting our fourth cut of 2024. Lizzie Burden is at the headquarters in Frankfurt. Lizzie, good morning to you. It's been a couple of weeks since there was a frenzy about a 50 basis point rate cut. I think JP Morgan are still tabling that in, but the consensus is 25 basis points for now. How dovish a cut will it be?
Well, you've also got Martin Kazaks, the Latvian central bank governor, saying that it's still on the table. But I agree with you, Manus, it's looking unlikely. You have had those risks emerging since the last meeting. France and German governments collapsing, less fiscal tightening possibly for the ECB to rely on, Trump being elected and the euro area very much under threat from tariffs from America. So maybe you actually get that feeding into not a jumbo cut today, but a downgrade in the forecast for inflation and growth. Of course, we had Christine Lagarde at the last press conference saying that the inflation risks were tilted to the downside. You had that PMI in November as well. And you could see an update in the statement to the language to be a bit more dovish, as you say, because last time they were talking about keeping rates sufficiently restrictive for as long as necessary. Maybe that gets tweaked this time.
And it's interesting because we've gone through this round of negotiation of wages in Europe, in Germany, I should say. Negotiated wages accelerated to 5.4% in the third quarter. To a certain extent, this is what makes the ECB very, very nervous. We saw a tick up in inflation. Growth wasn't as bad as they expected. And then you have this wage acceleration. But does that fade into 2025?
Well, that's exactly the sort of argument that the Hawks would be making against a jumbo cut today. Interestingly, you saw off the back of the US CPI print, because of the changes in Fed bets, actually traders adding to bets for ECB easing by the end of 2025 as well. Look, the bigger question is, if you look at where neutral lies and whether they should go below it and how much further below it, and that comes down to how much monetary policy can do. And as you were discussing earlier, what kind of inflation and growth risks you have in the euro area. We, of course, had this report from Mario Draghi spelling out bluntly that you've got, poor productivity, demographic issues, the lack of financial integration across the euro area. There's not much that cutting interest rates can do about those issues. And that's precisely why the likes of Isabel Schnabel would say you've got to stop cutting rates sooner than perhaps traders would like. Yeah, well, the divergence is pretty splendid in lots of different areas, from bond yields to currency to economy. Lizzie, thank you very much. We'll track the ECB with you throughout the day. Lizzie Burden there at the ECB headquarters in Frankfurt. President-elect Donald Trump has been busy picking his cabinet, according to a report from CBS, though. He's now thinking that who will attend his inauguration. The report is that Trump has invited Chinese President Xi Jinping to the day as he re-enters the White House. Let's get to our White House reporter, Stephanie Lee. Stephanie, here we are. This is one of the best stories that I've read, reaching out to President Xi to come to Inauguration Day. The likelihood of this is fairly thin, isn't it?
It is, as far as we know right now, it does not seem likely that Xi Jinping will attend the inauguration, but it is in keeping with Donald Trump's past remarks and his campaign trail speech to reach out to foreign leaders and to develop a relationship in order to maintain world peace. And that's something that he's been pushing for months and months. So it's not unexpected that he's been taking these meetings with foreign leaders and reaching out to them.
Indeed. Well, another piece of news, of course, that the FBI director, Christopher Wray, has announced he will resign, and this is going to be before inauguration. And to many, this lays the path for Trump's #1 pick to head the FBI, doesn't it?
Certainly. And as far as I know, in terms of my conversations with members on the Hill and with their staffers, it doesn't quite seem like there's been much pushback in the way that we've seen Hegseth and perhaps some of the other nominees get flack or have controversial headlines come up. So as far as we know right now, this does seem to lay the pathway, as you mentioned, for Patel to take the reins of the FBI.
Yeah, well, obviously Christopher Wray saying, look, it's the best way of dragging the Bureau deeper into the fray. So maybe a pragmatic response. That relationship, of course, souring over the past couple of years between Trump and Wray. Also, we've got Bloomberg reporting that Meta made a donation to Trump's inaugural fund. Now, this is a shift for Zuckerberg. We know that he was very praiseworthy of Donald Trump when there was the assassination attempt, called it badass. But this is quite a shift at a corporate level, isn't it?
Certainly. And, what we've been seeing in recent weeks with the relationship of Elon Musk growing closer with Trump, as well as many other CEOs starting to come back into the fold, this seems to be following that trend of business leaders showing their favor or their support behind the president. And so as we're looking at this inauguration, the committee is beginning to solicit funds. And so Meta is just one of the many people who have begun donating to put together this inauguration.
Well, they're all there. I mean, Tim Cook, Sundar Pichai, they're all getting closer and closer to president-elect. And just think, Donald Trump, I think, called Facebook enemy of the people at one stage. That was a bit of a shift, one could say. Stephanie, thank you very much. Stephanie Lai there, our White House reporter on the latest political stories of the day. And now our exclusive interview with Bloomberg's David Gura. He sat down with the Treasury Secretary, Janet Yellen, as her post nears an end. Let's take a listen.
Well, I am concerned about the fiscal outlook, and I believe that deficit reduction is necessary to keep us on a sustainable fiscal course. Now, President Biden signed into law $1 trillion of deficit reduction over the next 10 years. He did that in the agreement to raise the debt ceiling. And our budget proposes an additional $3 trillion of deficit reduction over 10 years. And I think that's necessary to make sure that our fiscal path is sustainable. Now, Congress hasn't really done anything to, beyond what I've mentioned, to improve the fiscal outlook, and I think that's a shame. I'm disappointed in that, and I think Congress needs to work hard on that. There is a threat going forward that many of the provisions on the individual tax side of the Job Cuts and Tax Act, JCTA, enacted by the Trump administration in Congress in 2017, they will sunset at the end of next year. And many Republicans have expressed a desire to keep all those provisions in place. CBO said that will cost $5 trillion over 10 years. So that really is, and so that would be a blow in a situation where I believe an additional $3 trillion, that not doing the $5 trillion and $3 trillion more is necessary. And if the provisions are just extended, this will be a serious blow without finding ways to pay for them. We proposed a lot of pay-fors that we think would fairly ask corporations, wealthy individuals to pay their fair share. We've negotiated an international tax agreement that would create a level playing field worldwide for multinationals. The United States has not yet joined, although many other countries have. And that would be a revenue-raising measure that I think would be very valuable. And there are certainly more. So I do hope that the new administration and Congress will, if they extend features of JCTA, find ways to pay for what they do, and also make sure that the benefits go not to the wealthiest individuals, but to middle-class families.
Treasury Secretary Janet Yellen there, speaking exclusively with Bloomberg's David Gura. Currency is definitely in focus. We're counting down to the ECB. Will you get your fourth rate cut of 25 basis points is the general consensus. Euro is flat at the moment, 105.02. Dollar Swiss is where the real sort of action was today. The SNB went for a 50 basis point cut, and they've shifted their language. They will adjust monetary policy if necessary. The dollar was up by 0.5%, and the Swiss franc was down nearly 0.6% at one juncture. So we've just bounced back from the highs on the dollar. And the yuan is flat despite the gracious invitation from President-elect Donald Trump to Xi Jinping to come to his inauguration. This is Bloomberg.
I'm afraid that the markets are becoming overextended, and that, sometime in the future we will have a downturn in the markets. But I don't think it's going to be a very violent and very far. It will not go very far. So I'm extremely optimistic about the next 4 years and maybe even thereafter.
Hint of caution there coming from the Interactive Brokers Chairman Thomas Peterffy from the Goldman Sachs US Financial Services Conference here in New York. Let me set you up for the rest of your day. The ECB, their rate decision is at 8:15 a.m. Eastern. That will be followed by a press conference by Madame Christine Lagarde. Now, what she says and how dovish a tone she takes is going to be perhaps the more important to the expected 25 basis point cut. We count down to our own data here. US PPI and jobless claims at 8:30. Again, more pieces of the rate cut narrative. We're pretty much a lock for December. But again, it's a question of how hawkish a cut might you get here in the United States of America. On the earnings front, you've got Broadcom, Costco. They come after the market close. Some stocks that we are keeping a track of. You've got Adobe. It's extending post-earnings loss. They have a weaker than expected outlook amid concerns over AI competitiveness. Then you've got Uber. That's rising. Management made some upbeat comments on a conference call on Wednesday. The CFO said that the firm is not seeing any signs of a deceleration in growth in San Francisco, where Google's Waymo is operating. Keep an eye on NVIDIA this morning as well. They're researching autonomous vehicles in China, so that's certainly that space is heating up. And Keurig, Dr. Pepper gains as the firm maintains its quarterly dividend. Where are you? Pepsi, Coca-Cola, or Dr. Pepper? Okay, those are some of the stocks that you should keep an eye on. I want to leave you with a snapshot of what's going on under the belly. We've just given a little bit back here this morning. You saw the NASDAQ, the comp flying higher yesterday evening through 20,000. Post-CPI, December is a rate lock. There is one warning signal out there in these markets. The earnings yield on stocks, by the way, that's the closing on the cash, as you can see. Big psychological break level. But here's the thing. The earnings yield on stocks is now 130 basis points below triple B. You haven't had that since the GFC. Surveillance is up next.